Welcome to the Deep Dive. We're the show that cuts through the noise to get you the insights you really need.
Glad to be here.
Today, we are diving deep, really deep, into Social Security. It's a topic that, honestly, touches almost every single American life, directly or indirectly.
That's absolutely right.
Our mission here is to unpack it. What is this thing, Social Security? How does it work? Where did it come from? And why is it still so vital for millions?
Yeah, and it's important to start high level. Social Security is officially the Old Age Survivors and Disability Insurance Program, OASDI. It's the biggest social insurance program we have in the U.S.
OASDI.
Okay. And crucially, it's an earned benefit. That's key. This isn't welfare. You contribute through payroll taxes during your working life.
Right, you pay in.
Exactly. And based on that history, you earn the right to benefits. It's a critical safety net, really, a foundation for economic security.
Okay, let's unpack that earned benefit idea a bit more.
Yeah.
You stressed it's not welfare. So how does that earned aspect, funded by those taxes we see vanish from our paychecks, how does that shape its core purpose? The protection of retirement or disability or upon death?
It's absolutely fundamental. The whole thing runs on what's called a social insurance model. It's not like a private bank account where your specific dollars are saved just for you.
Okay.
Instead, it pools risk across everybody who's working. Think of it like a huge collective agreement. We all chip in.
A pool, right.
And maybe the most interesting part is the social contract between generations. It sounds kind of grand, but it's simple. Workers today pay for the benefits of retirees and others receiving them today. And the understanding, this sort of promise, is that when today's workers need benefits, the next generation of workers will pay for them. It's this continuous cycle.
That intergenerational idea, it really requires you to understand the history, doesn't it?
Right.
To get why it started. We have to go back. Think about the 1930s, the Great Depression.
A devastating time.
Yeah. It wasn't just like an economic dip. It was a catastrophe. People were incredibly vulnerable. And older Americans, something like half of them were living in poverty, often relying entirely on family or charity.
That's correct. The dependency was immense.
So this sets the stage for FDR, the New Deal, and this revolutionary idea. What was the real spark?
That sheer vulnerability was the spark. The Social Security Act of 1935 aimed straight at that fragility, trying to build a basic floor of protection.
Right.
But, and this is really important historically, the initial version was, well, it was much narrower than what we have now.
Narrower how?
It actually excluded a lot of people initially, farm workers, domestic workers, which meant many minority workers weren't covered at the start.
Wow. I didn't realize that.
Yeah, it's a crucial piece of the history. But over the decades, Congress expanded it significantly. Disability insurance got added in 56, Medicare in 65.
Oh, Medicare calculator. Okay.
Yes, and eventually coverage grew to include almost all workers.
Right.
But the core idea, the fundamental purpose, stayed the same. Provide a foundation, not your whole retirement plan, but a base level of income security, enough to prevent, utter destitution.
Okay, so that's the what and why. Let's get into the how, the mechanics. You mentioned pay-as-you-go. Can you walk us through what that actually means?
Yeah.
How do my contributions today turn into benefits for someone else and those taxes?
Right. The pay-as-you-go system, it's pretty literal. The money coming in from current workers' payroll taxes is essentially immediately used to pay the benefits going out to current beneficiaries.
So it doesn't sit in a vault somewhere?
Nope, not in an individual account anyway. It flows through. Now, those taxes, you pay 6.2% for Social Security from your wages. Your employer matches that, another 6.2%.
It's 12.4% total.
Correct. But, and this is a big point in policy debates, that's only on wages up to a certain limit each year. For 2024, that cap is $168,600.
Okay, so higher earners pay that tax on less of their total income, percentage-wise.
Exactly. If you're self-employed, you pay the whole 12.4% yourself, the employer and employee share. And then there's the separate Medicare tax, 1.45% each, with no income cap.
Got it. And how do you actually qualify to get these benefits eventually? Is it just about paying in?
It's about earning credits. Think of them like work credits. In 2024, you get 1 credit for every $1,730 you earn, up to a max of 4 credits per year.
Okay, 4 credits max per year.
Right. And for retirement benefits, most people need 40 credits.
So about 10 years of work, give or take.
Yeah, roughly 10 years of substantial work gets you qualified for retirement. For disability, it can be fewer credits. It depends on how old you are when you become disabled.
And the benefit amount, how's
Yep.
that figured out?
Okay, so the Social Security Administration calculates your primary insurance amount, the PIA. That's your basic benefit amount. They look at your highest 35 years of earnings.
Highest 35. Okay.
And they index those past earnings for wage inflation, so it reflects their value today. Then they use a formula, and this formula is progressive.
Progressive, meaning
Meaning it replaces a higher percentage of pre-retirement earnings for lower wage workers compared to higher wage workers. It's weighted to give more support proportionally to those who earned less.
interesting. Most people hear Social Security and just instantly think retirement check.
That's the common thought. Absolutely.
But that's really just scratching the surface, isn't it?
Yeah.
What other kinds of protection are baked into this system that maybe we don't think about as much?
Oh, it's much broader. Yes, retirement benefits are the most common. You can start them early at age 62.
But you get less, right? If you start early.
Exactly. Your monthly payment is permanently reduced. Your full retirement age depends on when you were born. It's gradually moving from 66 up to 67.
Yeah.
And if you wait even longer, up to age 70, your benefit actually increases.
Delayed retirement credits. Okay. What else?
Then there are disability benefits, SSDI. This provides income if you have a severe medical condition that stops you from working. And it has to be long-term, expected to last at least a year, or be terminal.
And that's a tough process to qualify for, I hear.
It is. It's quite rigorous. Strict medical and work criteria. Then there are survivor's benefits. This is huge. If a worker dies, it provides support for their family.
Like who specifically?
Surviving spouses can get benefits, sometimes as early as age 60 or even 50 if they're disabled. Children, too, usually if they're under 18 or older if they became disabled before age 22. Even dependent parents in some cases.
Wow.
And finally, don't forget spousal and family benefits. Even if a spouse didn't work much or at all, they might be able to get benefits based on their working spouse's record. Up to 50% of the worker's main benefit amount. Dependent children, too, though there are limits on the total amount a family can receive.
That's a lot more comprehensive than just retirement. It's like a whole family insurance package built in.
That's a good way to think about it. It really is.
Okay, let's shift to the money side. The financing. We hear about the trust funds. What are these exactly? How do they work?
Right, the trust funds. There are actually two. One for old age and survivors insurance, OASI, that's the retirement and survivors part, and another for disability insurance, DI.
Okay, OASI and DI.
And remember that pay-as-you-go idea. The payroll taxes collected go into these funds, but it's crucial to understand they're pooled. It's not individual accounts.
Right, you said that. Pooled.
Any money that comes in beyond what's needed right away to pay benefits, the surplus gets invested. It's put into special U.S. Treasury securities. Basically, the Social Security system is lending money to the federal government, and it earns interest.
Okay, so connecting that to the bigger picture.
Yeah.
This is where all the headlines come from, right? About Social Security running out of money. What's the real story there? What are the projections?
Yeah, those headlines can be alarming. The official projections, like from the Social Security trustees, are definitely something we need to pay attention to. The estimates currently suggest that the combined trust funds, OASI and DI together, are projected to be depleted sometime in the mid-2030s, maybe 2034, 2035, around then.
Depleted, that sounds bad. What does that actually mean? No more checks?
No, that's the critical misunderstanding. Depleted doesn't mean the checks stop or the program collapses. It means the reserves, those Treasury securities built up from past surpluses, would be used up.
Oh.
At that point, the system wouldn't shut down. It would still have incoming payroll taxes from current workers. But those ongoing taxes are projected to be enough to cover only about 80% of the benefits that are scheduled under current law.
80%. So still significant, but not the full promised amount unless changes are made.
Precisely. It means Congress would need to act to avoid roughly a 20% cut across the board for all beneficiaries at that time.
Okay, so we've covered the system, the benefits, the trust funds. Now, that future challenge you mentioned, the projected shortfall, what's driving that? Why is this happening?
It really boils down to demographics, mostly. It's a slow-moving but powerful shift. The biggest factor is the retirement of the baby boomers.
The huge generation born after World War II.
Exactly. A massive number of people moving out of their working, tax-paying years and into their benefit-receiving years. This increases the number of beneficiaries dramatically.
While the number of workers paying in isn't growing as fast.
Right. The worker-to-beneficiary ratio has dropped significantly.
Yeah.
Back in, say, 1960, you had over 5 workers paying in for every person collecting benefits.
That's one. Okay.
Today, it's fewer than 3 workers per beneficiary, closer to 2.7 or 2.8, so fewer workers supporting more retirees.
That math seems tough.
It is. And add 2 other factors. People are living longer, so they collect benefits for more years on average.
Increased life expectancy.
Yes. And combine that with relatively slower wage growth historically and lower birth rates compared to the boomer era, and you get this long-term structural imbalance between money coming in and money going out.
So what's the scale of this imbalance? Like, how big is the gap? And what kinds of fixes are on the table? Obviously, we're not taking sides, just outlining the options people discuss.
Sure. The official measure is the 75-year actuarial deficit. The trustees estimate that's currently around 3.5% of taxable payroll.
Okay, 3.5%. What does that mean in plain English?
It means that over the next 75 years, if we made no changes at all, the system's income plus its current trust fund reserves would fall short of covering 100% of promised benefits by an amount equal to about 3.5% of all the wages subject to Social Security tax during that entire period.
Okay, it's a significant gap that needs closing. So the proposals.
There's a whole range, and they all involve trade-offs. Some focus on increasing revenue, things like raising the payroll tax rate slightly for everyone, or maybe just for employers or just employees.
Mm-hmm.
Another big one is adjusting the cap on taxable earnings. Right now, income above $168,600 isn't taxed for Social Security. Some proposals would raise or even eliminate that cap.
Taxing higher incomes more.
Yes. Then there are options focused on the benefit side, gradually raising the full retirement age further, maybe to 68, 69, or 70.
People working longer.
Right. Or changing the formula used to calculate the initial benefit amount, perhaps making it slightly less generous for future retirees, especially higher earners. Or adjusting the annual cost of living adjustments, the QLAs. Some proposals involve means testing, reducing benefits for wealthier retirees who might have other income sources.
Lots of levers to potentially pull.
Indeed, and every single one affects different groups differently and has real consequences. That's why finding political consensus on a solution package is so incredibly difficult.
It really brings us to the core question then. We've talked structure, history, challenges. But why should this matter so much to you, the listener? What's the real-world, maybe unseen impact of Social Security?
The impact is just immense and often underestimated. Let's look at poverty. Social Security literally lifts about 22 million Americans out of poverty every year.
22 million.
Yes, and that includes around 15 million seniors. Think about that. For a huge slice of the elderly population, roughly 40%, Social Security provides 90% or more of their total income.
90% or more for 40% of seniors?
Yeah.
It's not just helpful, it's their lifeline.
It absolutely is. Without it, their poverty rates would skyrocket.
And there's that invisible insurance aspect too, right? Beyond the retirement check.
Yes. This is so important. Think about a younger worker, maybe in their 20s or 30s, paying in. Those payroll taxes aren't just for some far-off retirement. They are also buying incredibly valuable disability and life insurance right now.
How valuable?
For a typical young worker with average earnings, the protection offered by Social Security's disability benefits is estimated to be equivalent to having a private disability insurance policy worth maybe $750,000.
Wow.
And the survivor's benefits. That's like having a life insurance policy worth around $900,000 protecting their family if the unthinkable happened.
That is a massive, often completely overlooked value embedded right there in your paycheck deduction.
Exactly. It's providing peace of mind and real financial protection from day one of your working life.
So wrapping up this deep dive, it's crystal clear. Social Security isn't simple, but it is absolutely foundational. It's complex, yes, deeply woven into American life for, what, nearly 90 years now?
Almost 9 decades, yeah.
And while it definitely faces real financial hurdles that need serious, thoughtful solutions from policymakers, the core structure is sound. Its importance, its impact is just undeniable.
Absolutely. And maybe the final thought to leave with you, the listener, is this. We're in the middle of this ongoing discussion about reforms. How do we, as a society, preserve these vital protections for the generations coming up behind us? How do we maintain that social contract?
That intergenerational promise.
Exactly, the one that's been such a bedrock of economic security since the Depression. Understanding all this, it's not just abstract policy. It directly impacts your own financial planning, your family security, and how you might think about and participate in this really crucial national conversation going forward.